Well, corporate tax rate is the territorial versus global is a major changer with regards to where companies will locate. The United States is now having a competitive advantage. And, obviously, those that live in Connecticut, New Jersey, and what's that state? New York, are paying higher taxes, whereas most of the commentators may say we're paying lower taxes, which is not the case. That is an element. And then you look at the notion of receipts in the United States. How much are we taking in, and where's it coming from? And wages are 80% of it. The corporate taxes are about $300 billion out of, and you look at that and say, okay, so taxes are a plus. But incrementally, the companies that I'm talking to are either spending a little more, doing a lot of things, and that'll neutralize the benefit of the incremental absence of the higher growth rate from taxes next year. And then the other one is technology. And you find companies that are service companies in the United States that have a technology bias and can do productivity gains by setting up routing better. Those have been very helpful.
Give me a name.
I just have a name that I happen to own forever. It's called Rollins Inc. They get rid of bugs, like termites. Like right now, you have a little bug on this counter. You got to eliminate them. Companies like Ecolabs and so on. And then, simple things like in the healthcare area, Teladoc. That stock is now $77. Unfortunately, I blinked and it's gone from 40, TDOC, 42 to 77, and like that.
I'm going to test your ticker acumen today.
A ticker? I got a ticker. It's working.
The 10-year Treasury is on that list.
Yeah, well,
that's the fearsome foursome of what you're watching.
Major headwind.
Major.
Sure, it's got to have a compression on the present value of the future stream of earnings down to present value. Can you sustain a business that has a 12, 14 multiple on the that everyone wants to buy? Can they get that 5 years from now in an exit strategy? And I'm in the camp that says unlikely.
Yeah, the 10 years a bit above 3. Is what's the level that it gets to where you say it becomes punitive to the market?
You got to go stock specifics. I'm looking at each company and saying, how will recover? Is it a business that's transaction driven or recurring revenue? And if it's recurring revenue, what multiple is the company selling at today relative to what I think is a logical explanation of where it should sell or economic value? I don't want to get into the Nifty 50 where these stocks are continuing to be narrowly bought, continuing to grow, and chasing the same names. So I can't answer whether it's 333 or it's 340 or 40. But we know that the massive withdrawal by Draghi, Jay, and the guy in Kuroda, Powell, but the guy in Japan, Kuroda, taking that money back, that's got to have a headwind on top of what rising rates look like.
What if the way to look at that, though, and historically this would be accurate, would be to say it's better to be off of zero, A, because conditions no longer warrant that, and B, if something negative does happen, whether it's an exogenous shock or a military thing or whatever, now there's some ammunition back in the, we heard people say the Fed is pushing on a string, it's not going to work. So it did. So now it did work. And if you need to do it again, now you're able to because you're not on zero.
It's about time.
Well, I'm just saying normalizing is good, right?
Well, 2.10, 2.20 on the T-bill, 3 months, 6 months. It's very interesting. Right. Particularly in SALT-free states where you buy 100% Treasury, you don't pay any tax.
Cash is now an investment again. There's a yield on cash. Not a good investment, but you now have a situation where there are options beyond the stock market. So maybe that's a healthy thing.
If I look at the next 10 years, Josh, and I buy an ETF, I'm going to make 6 to 8%. Higher earnings, but lower multiple. And
hopefully,
we are.
Hopefully. Yeah.
Well, I like lower multiples. It gives you a greater margin of safety. I'm looking for margins of safety in the world. And then you have what happened in October 1987, where there's some dynamic with quants, algos, and so on that you never understood.
Well, I think in February we got that. What you're talking,
you got a little bit of that.
We got a great margin of safety. You were able to buy the S&P down 11%. certain select tech names that everyone loves were down 15%. You had that moment. And
it was on the same reasons that we're talking about today.
Right. You had about a week, but you had to do it right immediately. But you had an opportunity.
Yeah, but here's the point I'm driving at is whether it's inflation or 10-year yields, they really are where they were back in February. So, now we're having the same discussion about the same things, but the market's a little bit higher. I mean, one of the things I've learned is, look, as a long-term investor, I have a 3 to 5 year outlook. But the problem is you've got to walk in the real world right now. The market is telling us something right now. Volatility is going down. The S&P 500 is going up. I'm not going to fight that.